Welcome, everyone. Thank you for joining. Thanks also, Christophe, Raoul, for this another amazing session of, or at least edition of Brussels Blockchain Week in this beautiful Merode. Purpose of today is to share indeed the VC perspective of the investment landscape. If you think about, it's been almost 10 years since the ICO of Ethereum, which has most probably for many people here in the audience been rather impactful in their Web3 career, and has also shaken up the way that founders and new tech innovations are being funded. And especially over the last 9 to 10 years, we've seen a constant shift from the ICO craze, where the public crowdfunding was a bit too much on steroids, with a lot of pros but many cons, going back to the equity model, traditional VC investing, which is also a concept that hasn't been around for that long, maybe a few decades, and then venturing into the hybrid model. So really, all the challenges that are involved with this ever-changing landscape is something that the VCs are right in the middle of, and that's what we're going to be doing today, to learn more about their experiences, but also how they look forward to the future, on how they're going to manage this ever-changing landscape. So it's my pleasure to introduce you to Lawrence, William, Nicolas, and Nicolas. We'll start with the left, Nicolas Vassaux, who is the co-founder of Noya. Noya is an early-stage investment fund which has a hybrid model where they also have a liquid portfolio that they actively manage. We actually met the first time 6 years ago in London when you were setting it up, so we go way back, and it's been doing really well over the years. Same applies to my other friend Nico at Keyrock Capital, who's a co-founder and CIO of the fund. They're an early-stage fund. They do seeds and Series A investments. And Nicolas has got an extensive background in private equity, both in the US as in Belgium. And they've been doing really well over the years here out of Luxembourg and Brussels. And if William, based out of Paris, they run Atka. He's one of the co-founders. It's an end-to-end incubator that has been supporting over 60 projects over the last few years. They helped raise around 35 million for their companies, and the complementarity with such initiatives with the VC space, they're also an active investor, is second to none, and it's great to have such entities being super active out of Europe, especially out of Paris, which is becoming more and more of a Web3 hub. And then last but not least, we got Lawrence. We met 2 years ago. Lawrence has an extensive background on the fintech VC investment sides, and then joined the good side, the dark side, or the good side, the light side, by becoming partner at Kraken Ventures and being responsible for the European activities. Lawrence is also rather active here in the Belgian VC ecosystem with Syndicate 1, etc. He's a real ambassador to the investment space, and it's really great to have them all here. Before we dive in, are there any other VCs in the crowd? Raise your hands. None. That's good. That's positive. Did anybody raise here from a VC? 1, 2, 3, 4. Nice. Well, speak to them later if you're raising. Did anybody not raise from a VC? Did like a token issuance or anything like that? Okay, this is awesome. There's going to be a lot of insights then. Super nice. So let's start off. Fully diluted valuation. Vanity metric, something that is actually valuable. How hard is it sometimes to explain to your LPs that you invest into a 8-figure company early stage? What do you think? Let's start with Nicolas.
Thanks, Stef. Happy to take that one. So I think FDVs. Not sure how familiar you guys are with that, but basically those are the network values of token projects. So basically all the outstanding tokens times the price that you pay for those tokens. Typically, those valuations are much higher, especially in bull markets, than comparable equity valuations. I would say the two big differences are, one, that it's non-dilutive. So a token valuation, typically the supply of tokens is fixed, as opposed to shares where you do future capital rounds and so forth. The shares increase, so you don't get diluted. If as a VC you invest in a token, you acquire your fixed share of that token network. So it's, imagine like having 2%, 5% of a company forever without ever being diluted. I think that's one key difference. If you invest in equity as a parallel, you typically as a VC expect to get diluted about 50% over your hold. So if you acquire 5% out of the get-go, you probably end up with 2.5 when you exit. So I think that's one key difference. And then the second one is that with token networks, typically VCs participate and increase their stake over time. So same example, if you acquire 2% with staking and securing the network, you get part of the future supply that is being issued and can grow your stake. So those two combined, basically, without getting into the details, create a ratio 3 to 1, basically, in terms of comparable valuations with equity companies.
Yeah, I think for the fully diluted valuation, of course, it is not like a sheet metric, and it's clearly tied to a project, a protocol, and the complexity is that very often it's not necessarily relevant, like in some sectors, like for example for gaming. The problem with acquiring tokens and like that are valued with a high FDV compared with the equity value is that basically those tokens are tied to a specific game, and basically in gaming, like there are many iterations until you find like the proper game that is gaining traction, and the problem is that the value is captured like rather by the studio, so the equity, rather than by a specific game that you invest in. So it's kind of a problem that we are trying to avoid now. It's like basically not investing in a token when it is a segment that like the token is not necessarily relevant.
And do you feel there's better metrics for you guys to make a decision or to put some type of valuation on a very early stage token ecosystem?
Yeah, no. Yeah, maybe also just to add, and then also to respond to your question, I couldn't agree more with William and Nicolas on the token side. I think maybe just to take a little bit of a step back, like we invest in pre-seed seed, so preferably in the first rounds that entrepreneurs are raising, and then the question is how are they raising money, right? And so when I started off in investing in crypto 2-3 years ago, it was actually much more common to immediately invest in SAFTs, so token sales, token sale agreements as well. Now, these days, it's actually very common to raise equity and then have a token warrant on top. And we do actually like that as an investor because it is sometimes a little bit difficult to predict upfront where the value will accrue. Will the value accrue to the equity as a more centralized company, or will they actually will this company actually fulfill its ambitions to completely decentralize the company over time, where the equity becomes more of a developer sort of core unit, and the value will start accruing into tokens as sort of a central store of value in the ecosystem they're building. And so if we think, to your question then, if we think about valuation, we do look at both, right? But the equity valuation is sort of the prime valuation we look at. And then it's all about, okay, how much of the token supply will we need to incentivize community? And how are we looking at the pie? And so typically we like a 2-to-1 token warrant where the FDVs naturally from the onset put at a higher valuation than the equity.
Nicolas, given your hybrid model, etc., you must have the experience of seeing a lot of these deals go through as well.
Yeah, look, I fully agree with what you just said, Lawrence. I think with the different, when how those entrepreneurs have raised funds over the last few years, I think that, it would make more sense when the company is really early stage to raise equity, as you said, Lawrence, because you don't know the future. And, the issue, the problematic, I think, in the past, projects were raising through SAFT, but when you raise through a SAFT, there is no governance set. As an investor, you have no power. You can't do nothing, right? When you raise equity, it's kindly different. I mean, at least you can shape some kind of governance somehow. And what we have seen as well in the past is usually conflicts of interest between, you know, equity, the tokens. And what we have seen as well lately is projects have been raised through tokens, issuance of tokens, but now raising equity because the token went down and they want to raise equity to buy back the token, to make the token, you know, kind of create new kind of hype around the tokens. So these are all things that we see, and it's up to, I mean, that's why you need to be 100%, devote 100% of your time in this industry to really understand and be able to see those problematics and try to really, valuation is something that's really subjective. So it's, I mean, any project we might have different valuations, the four of us guys, but indeed there's some you know, frameworks and ways to value things, and I think those conflicts of interest and having equity in token brings some kinds of tricky situations. But it's not an easy one, as you said, Stef.
I guess as an incubator, these are typical questions that you get from a lot of your companies, right? So on valuation, how do these complex legal structures come into place?
Yeah, definitely. Actually, I agree with what you said, guys. Now, like the typical model is really equity with a token warrant. It's the model that we recommend. But I would say that in certain sub-segments, like DeFi, like the value capture model, like that goes like toward the token, it has proven to be quite successful. So, like for really DeFi protocols, we tend to push them to be more like a launch a token round and not necessarily an equity round. The problem that we are facing with like many early stage crypto projects is that usually like you have an excellent team. They have not only one idea but actually many others. So like basically once they ship like a protocol, either they are interested in like improving the protocol and so on, or they could just create another tool, another protocol, and then basically it's a bit complicated for the investors of the previous protocol of the previous project, because basically like they would not be exposed to the success of the future one. So we have the impression that actually this is the kind of problem we could face like in crypto, but for DeFi it seems that the founders are more geared toward basically improving one protocol and not like creating a set of tools and so on. So that's why we are.
I think maybe one point to add, Stef, is around valuations, right? Is at Tioga more and more we start looking at tokens in the same way as we value equity in companies. For the audience, you know, a token is a very abstract concept, and probably 99% of the tokens out there, you know, have no reason to exist or overvalued or speculative, all of that. So you got to be very careful. But for a subset of those tokens, they really resemble equity. And they resemble them in the sense that they have cash flow rights. So a protocol generates, you know, value, sometimes tens of millions or more. And that value that is captured basically flows back to the tokens and can be paid out as dividends, you know, in the same way as a company does that. So that's one element. And the second element is the governance part. You know, as a token holder, you can vote on proposals on certain commissions and so forth. So basically the governance and cash flow part are very similar to equity. And we start looking at those token networks much more in that fashion, kind of like, you know, if that were an equity company, by holding those tokens, what is a value we could pay for that company? If you apply that to the public markets, you see that most valuations don't make sense. Still in the bear market we're in right now, you see kind of like, you know, multiples on profits like 100, 200, even sometimes 1,000x. So I mean, it's a tough area to navigate. But the point I wanted to make is that tokens are not that abstract and can be seen as a digital form of equity for a whole set of projects as well.
Maybe if I can just add one topic, one comment is, I think that even entrepreneurs, they don't know really how to raise money, right? You have the equity, the token. So I think what I would recommend is that, I mean, before, you know, having set things and your terms, just go and reach out to a couple of VCs and just to be challenged on how you should raise money, right? So I think that's as well maybe just, yeah.
Or apply to the incubator program.
Yeah, very good.
Yeah,
I guess.
good point.
Yeah.
Now, just on the typical ratio, like basically we mentioned the fact that like we have equity plus token warrant on a 2-to-1 ratio. This ratio is, for me, it's a bit disturbing. Like basically, like I would say that that basically when you it depends on the project, but like when you are launching a kind of a project oriented to consumers where you like that should be used by like retail users, you could expect that the network valuation would be much higher than the equity, and that you would distribute a lot of token to users. So if like the investors should not necessarily have like a very important part of the tokens, and like basically this 2-to-1 for me it favors a lot investors compared with like the users, but just.
What do you mean? Which ratio would you recommend?
So the 2-to-1 ratio when you are.
So you would recommend 3-to-1 or?
Yeah, basically like giving some space to put in, to favor the distribution of tokens to early users of the protocol and so on. So basically, and I think it would be more interesting.
Yeah, just to be clear for the audience, so 2-to-1 means you actually sort of mimic your equity cap table to 50% of the token network, and then you have 50% left in the supply, which you typically would distribute to community through incentives to basically reward your users. And so the discussion here is about the right ratio, but maybe let's not get into the technical details.
It's indeed technical, right? And I think if you look at all of these agreements, those are very much based on a legal foundation, but also on how much impact a lead investor has in the valuation, and also taking sure that the structure is set in a way, right? So maybe going to the point of the role of a lead investor. I think especially over the years, you've seen that a lot of the very well-known VCs, predominantly out of the US, has grown incredibly big, where they leverage not only their name, but also their size to either get favorable allocations or actually decide on valuation / the structure of a deal. You've been in the US, a lot of these US funds. Maybe it would be great if you can share your experience on how that has evolved over time, and not only how sometimes that is a challenge, but also the opportunities it provides for maybe Europe, for example.
Yeah, no, I think two points, Stef. One obviously on the role of a lead, and then the second one kind of like the US versus Europe. I think the role of a lead, so for us at Tioga, we lead most of our investments. I think out of the 15 investments, we're a lead on 8 out of the 15s, and we're on the board on all the companies. I think it depends on your model. There's no right or wrong. For us, it's what we like doing. We like being involved. We like being on the boards. We like opening up our networks and so forth. So we're active investors. We're not operators, but we're proactive towards our founders, and got very good feedback on that front. So that's the reason we like leading. Obviously, leading a round allows you to get a bigger stake in the round, to work more closely with the entrepreneurs, with other investors, bring the right value add on the cap table, and so forth. And also in bear markets where founders need you the most, basically be there and help them navigate this. So I think that's really kind of like the advantage of being a lead investor, next to some governance rights that you also have obviously. Now on the US, I think when we started with Tioga, let's say late 2018-19, we were thinking about setting up a fund in Europe. There were maybe 2 or 3 European funds, and I think we look at the stats at that point in time. European Web3 VC was about 1% or something of the capital that was raised in the US by some mega funds as A16Z, Paradigm, Multicoin, and so forth. I think we're at 5 to 10% of that capital now, so Europe is still kind of like an order of magnitude at least smaller than the US. What we hear a lot from founders, though, is that big US funds, and I don't want to pick on any in particular, basically sell their brand names. And that's kind of their real value prop, and that's very advantageous for later rounds where you need to attract tens of millions for a future round. That said, though, imagine you manage $1 billion fund, investing €1 million in a startup doesn't mean anything, right? They have 100 startups, 150 startups, and you get very little attention as a founder at the seed stages from those bigger US funds. So we see founders preferring local funds, boots on the ground, the proximity to entrepreneurs, and so forth. And typically, also funds with a network with those US counterparts to come into later rounds. So at Yoga, for instance, we I think have 3 examples in our portfolio where A16Z or some US funds came in after our first investment. I'll stop here. There's much more to say about that, but I think those are some high-level takes.
Yeah, I can add. Yeah, and I mean, it's a good question. I think maybe we're conflating a couple of criteria together. Like, there are, I mean, in theory, I work for a US fund, right? But we're a team in Europe. And again, in theory, I work for a US fund, but we're actually relatively small. So we currently manage $70 million AUM, and then indeed, if you compare that to an Andreessen who's managing a couple of billion, Paradigm, Hahn Ventures, etc. I think there's a huge opportunity to be actually a smaller VC, especially right now during a bear market, where you sort of fly under the radar of some of these funds, right? You have the opportunity to partner with amazing entrepreneurs in their earliest stages, where indeed, to Nicolas' point, you can basically lead those earliest rounds, build a partnership, build trust, and then build or leverage some of the relationships you have as a smaller VC with some of these larger VCs to do follow-on rounds. There is indeed a bit of a danger right now, and I think this is a topical time to discuss this, in a sense that there is still some dry powder. A lot of these really mega funds have raised a lot of money last year, but VCs have had a really tough time to be the tough guy, in a way, to entrepreneurs. What I mean with that is, over the past 5 years, we had basically a really great time. Everything was going up, and so valuations, especially in 2022, 2021, were really high for seeds and Series A's. And so these really big mega funds from the US are looking at these valuations now, and entrepreneurs always expect their valuation to go up, and they don't want to be the ones saying to entrepreneurs, well, actually, we will need to put some structure into your rounds, or maybe we should do a down round. And so a lot of these mega funds are now sort of coming down, and they're looking at seed and Series A's, because there they don't have to be the tough ones. But they're then pricing those rounds into enormous valuations again. So all in all, I think indeed, if you're an entrepreneur in this room, make sure that you, based on the size of the round you're raising, look at the total AUM of the funds that will be investing in your rounds, and make sure that you matter, that you're not a drop in the ocean. If you're raising $1 billion from a $5 billion fund, no one will care about you, right? And so make sure that you partner with smaller funds, at least as co-leads or part of your rounds, to make sure that you have someone to call to if you're in trouble.
They often say that the best VC is the one in a bear market that helps you, and that role is being played by a lead investor, but also maybe by smaller funds who have the capacity and the incentive to do so. Big portion of that, can I imagine? I think maybe a few people in the audience have that question as well. Is how do you manage treasury, right, in a bear market? Is this something that founders are actively looking into? Do they have specific crypto allocations that they de-risk themselves from? Do they hedge themselves? Do you support them on that front? William?
Yeah, it's an interesting question actually. So one of the specifics of this market in crypto is that when you raise funds, you could raise, and the mean to raise is stable coins or Bitcoin, Ether, and so on. So once you raised funds, unlike traditional startups, you don't necessarily put the cash in the bank and you wait and you spend it. You have like stable coins, and basically you need to secure them carefully, and you could also like allocate them, so like to put them at work basically once they are not in use, and so this is a tough choice, but I would even say that the choice of your stable coins matters, as we have seen last year, basically when there was this USD crash, so the Luna stablecoin, but there are also there had been in the past like DPEGs, as we say, of like a USDT or even a USDC during the Heller hack. So what matters is to diversify actually your treasury into multiple stable coins. There are some interesting products also to put the stable coins at work in a safe way, like for example investing in T-bill treasury bills and so on. So those are very interesting ways to put the money at work and secure them actually.
I think there are two different top subjects. Those that raise funds, typical projects that raise through equity, so they will get cash on the bank account, right? So usually those projects, they're not going to buy stable coins and convert that cash into a stable coin, and because simply sometimes the bylaws of the company doesn't allow it, right? So that's one topic, and then there is the other topic, as William was mentioning, the project that raise through tokens or stable coins. And then indeed there is a kind of trade-off of there is an opportunity cost, so the interest rate you can earn on putting that money at work, and then there is the risk of doing that, i.e. custody risk. And some projects have had part of their cash stuck at FTX, for instance. So that's something that entrepreneurs have to wait and put into perspective with respect to the cash they have on the bank account. Do they have 6 months of runway, 24 months? How much of your portion of cash do you want to put at work? I mean, these are all questions, important questions that and topics we look at as investors. And another topic as well is who has access to the bank account, or who is managing the private keys of the tokens. I mean, that's, I never know, right? So that's something that we usually ask, and you should make sure as an investor that no one can run with the money and operationally and legally speaking as well, right? So that's.
And I guess you guys as funds have to manage those things as well, right? You need to think about counterparty risk. Like maybe Nicolas, you have significant token allocations because of your investments. How do you manage it? Do you have within your mandates to have exposure to crypto, to chase yields in any sort of form? Like, can you maybe share some color on that one?
Yeah, sure. I think maybe one point on the other topic for startups, right? I think we're talking about managing their treasury, and that makes sense. The risk-free rate is around 5% now in the US, 3% in euros. So, if you raise a €5 million round, 5%, that's 250K a year. So it pays for a couple developers, so that, has an impact. and typically they do that through their brokers, banking partners, and so forth. So we encourage them to do that. That said, I think the bigger lever is to right-size your organization for the bear market. A lot of companies overhired last year, are sitting with teams that are way too big for the current market. And obviously it's a hard choice as an entrepreneur, but right-sizing your team for the bear market is crucial. And that has a much bigger impact than pure treasury management in our opinion. So hard choices, but that's typically what we guide entrepreneurs to as well. And now switching back to the fund, to our size, that heavily depends on your mandates. I think you guys probably have more flexibility than we do. We have to hold cash. We don't park our cash in stable coins or in crypto or anything like that. That said, we're allowed to invest in money market funds, term deposits and all of that to obviously get close to the risk-free rate. But there, I think it depends on the mandate, with some having more restrictions and others less.
Yeah, I think I really agree with you here, Nicolas. In a way, it's an opportunity cost. For every founder, thinking about how to optimize the 2, 3, 4% they can find on their treasury versus how to grow their business 10, 20, 30, 40%. So maybe this is an unpopular opinion here, but we typically just tell founders, keep your money in the bank. Maybe pick 2 banks. And let the banker advise you on maybe finding some yields that is close to the risk-free return, indeed. But don't think about it too much. Don't go crazy. Don't lock your treasury in Anchor. And that's also what we do as a VC.
So go ahead.
Same for us. Same approach as Lawrence. I mean, we're pretty conservative on managing our cash, and we push. I mean, our portfolio companies to do so as well. So, I mean, it's yeah.
We touched on banking. We touched on a bit on the US side of things. I think we cannot ignore the fact that this week was a few events happened, especially out of the US. We don't go too much into detail. I think we all know what it's all about. But these type of things must have in some way impact on not only perspective on the investment side, on the valuation side, but also on where you see globally the shifts happening, right? I think with Mika around the corner, and Paris and Lisbon becoming more Web3 hubs, you guys as a European focus must have probably a double, a mixed feeling, right? I think what happens in the US is definitely net negative for the industry as a whole, but it does open up quite some opportunities in Europe, I would assume. Do you guys feel the same about that? Maybe share some experience on what you guys are seeing right now in the market when it comes to Europe as an attractive venue?
Yeah, happy to take this one. So we at Kraken Ventures, we're a global team. We're 7 people across the globe. 4 of us are in the US, 2 of us are in Europe, and one partner is based in Asia, in Hong Kong. And I think first of all, taking a step back, by definition, crypto is borderless, right? But then in the end, people need to choose where to put their legal entities, where to build out their teams. And we see a huge opportunity for countries or regions that create a clear regulatory framework. And I want to stress clear. It's not always going to be perfect, the framework. But at least when there's clarity around the rules for everyone that is trying to play the game, then the game can be played. And I think what's happening in the US is total mayhem in the sense that there's no clarity whatsoever, right? Coinbase is actually suing the SEC, and then the SEC is going after Coinbase, and so it's like a game of chicken. I don't know what's going to happen. I think most people assume that with a change of leadership of the country in the US, that there might also be a change of an approach to crypto, blockchain, and a more clear regulatory framework. But until that time comes, there's a clear opportunity for Europe, a very, very clear opportunity for Europe. And MiCA is not perfect, but it gives a first framework that entrepreneurs can use to build their businesses.
Paris, William, you must be right in the middle of a lot of exciting stuff.
Absolutely. Actually, before working at Atka, I used to be one of the first employees of a crypto exchange based out of Hong Kong. So I've been working not only in Europe for crypto, but also in Asia. And what I could say is that when I came back to Paris, in Europe, more generally, I was really amazed by the level of the entrepreneurs working in crypto. I was also quite impressed with basically the quality of the investors in crypto and in Europe. And yeah, regarding the regulatory framework, of course, like any crypto entrepreneur, investor, people working in this space would criticize, would blame like the regulators, their local regulator for not being clear, but basically very rarely they know how it is made and like the struggles that are outside. For example, in Hong Kong, the regulation of crypto is way more unclear than what you could see, what you could experience in the US or in Europe, and basically when they enforce when they enforce some rules and so on, it happens like straight away. You have no way to defend yourself. So I would say that yeah, Europe could definitely, with a clear regulatory framework, be a crypto haven. Like basically, you have excellent entrepreneurs, high quality investors, and it's also a large market actually for crypto. So.
I think there is the indeed, as Lawrence rightfully mentioned, the clarity of the regulatory framework that's really important. But I think as well is the willingness of politicians, of all the people around, and what we've seen in the US is like maybe 1.5 years ago or 2 years ago there was a willingness, and our dear friend Gary was willing to help the ecosystem grow, and it kind of turned their back and changed their mind. And I think in Europe, with MiCA, so there is that framework that's, I mean, has its pluses and minuses, but at least there is something. And I mean, from my perspective, I mean, on the ground and talking to people, I see the willingness from politicians, and that's what this conference is all about, right? Is informing people and making sure that we all work together in the same direction. And we all understand what this is all about, right? And I think if you look in France, in Germany, even in the UK, Lisbon, where you, Nicolas, you have part of the team at Space there, maybe interesting to have some echo there. But I think that's, I mean, several European countries really going into that direction, which maybe as well, make the politicians, think about it and move faster than in other more maybe concentrate. If you think of Hong Kong, which is, I mean, really linked to China, right? Other countries, it's yeah.
I agree with everything that's being said. I think to put some numbers behind it, at Tioga we see about 2,000 startups a year. I think about 1,500 of them are European. The hotspots to us are really, as Stef was mentioning, kind of like Lisbon is growing like crazy, especially a lot of US founders coming to Lisbon. Regulatory clarity, good climate, tax advantages, grants, like all of those things attract a lot of folks, as well as the bigger conferences that are set up there towards the end of the year. Paris, obviously, Berlin, London remains big as well. So we've seen it increase over the years, and also have our team spread. We're a team of 8. We're spread between London, Brussels, and Lisbon, but obviously travel quite a lot. I think the trend is definitely trending towards Europe, and I think we'll continue to see that migration, especially what we've seen this year with the SEC cracking down on a lot of US companies.
Thanks. So we've got another 7 minutes. I still have a few things I would like to ask, but maybe it would be great to open up the mic for the audience if there's any questions. Great. I was going to say, if there's not, the guys are going to ask themselves questions, which is also maybe interesting, but I see already 2 hands here, so it would be really great to give them the mic, or if not, shout in the room.
I'm fine with shouting.
Shouting. Go ahead.
I want to touch on some of the problems we've seen with token voting, plutocratic voting, where the wishes of users and community are sometimes ignored, like we've seen with the Uniswap drama recently. What are the solutions that you would endorse as a VC that can solve some of these problems?
Yeah, I think it's a good question. So maybe to repeat it, I don't know if everyone heard it. It's basically on the governance side. We're talking about tokens that like equity allow you to vote on certain proposals. And I didn't get your name, but your challenge was that basically that governance is not set up properly, and community or small token holders are ignored and so forth. I couldn't agree more. I think we're definitely not there yet. How to solve it, I think it starts with setting up the cap table properly in the beginning. I think you guys had a little discussion on kind of like, the token ratio, is it a 2-to-1, a 3-to-1, whatever, right? With kind of making sure that the token is decentralized as much as possible. So not controlled by certain VCs, like Uniswap, we know there are some prominent VCs behind there. Easier said than done, right? Because it's always a balance between raising capital, getting kind of like the right partners early on, and decentralizing afterwards. And then I think it's the second part after setting it straight from the get-go, is basically being able to decentralize when it makes sense. So Uniswap is obviously a big protocol, but for smaller protocols, having to vote on every single decision is prohibitive to grow. So it's kind of like, and I don't have the perfect answer here. It's as you go, as you scale, basically disperse the token more and more, keeping enough of the supply for the community going forward so that it's decentralized, but don't lose in agility early on. So again, maybe not a perfect answer, but I think those are the 2 components that we see and I think are tough to navigate. And we're still experimenting as a space on what works best.
I think one solution that we're seeing today is the quadratic voting, so which allows today with all the decentralized identity, so you can really identify who is behind a certain bunch of tokens, and so really try to have a kind of sharing the votes linked more to the person, but how many people have tokens rather than how many each of them have tokens, and have the kind of power voting based on that. So that's something that's is emerging and being experienced in.